Hi guys, this is General for FX and you're welcome to the General's FX. And in this video, I'll be talking about the 6 best entry methods you will need in your setups, your trading plans, and trust me, when mastered, it will be game changing for you in your trading career. And so the first one, uh, let's not waste time. The first one we'll be getting into is price action in a consolidation, which often turns to a channel. If you don't know what consolidation means something that moves like this, like as if it's in the range. Like so it means prices are consolidating like this in a range. So my first example is this. Looking at this, you notice prices consolidating. Consolidating in that range, and that's all you need. Price consolidating in a channel like this. If you look at this, it looks like a channel, like a tunnel. That price is just not going above or below, not breaking out, just in that channel. Now what do you need for this entry? You only need the third bounce. Yes, you heard me right, the third bounce. Now the third bounce of the trend line, it means it might be the third bounce or the fourth bounce, but mostly in the market, with my experience, is the third bounce. Now look at this. You see price bounce on this first trend line, bounce on this second one, did not bounce at all, came to bounce on this third one. It means this is the first, second, this is the third bounce. That's all you need in this entry method. It is called price action in a consolidation, which often turns to a channel. All right, so this is the long example. Like when you are going long, you are buying. That's the long example. So what do you need? What you need is a channel, price consolidating in that channel, and you need a third bounce. Now after the third bounce, which happened here, this is the first, second. After the third bounce, what do you need? You need a volume candle for your entry. Now if you look at this place, this is a bullish engulfing, nice volume candle. I'll be going long from there, putting my stop loss somewhere below this place, and targeting the top channel, the top candlestick, the channel that is there. In this case, this is a 1-to-1 trade, and I will take it as my take profit. Now some other people might want to take the breakouts and all that. The breakout is for another day, but in this entry method, it happens that the third bounce happens to be third or fourth, mostly usually becomes the strongest. They usually break out of the channel if you decide to hold. And as you can see from here, if you are taking your long position from here with the stop loss there, look at how well it went. Now this is an example for the buy example. Now let's go to the sell example quickly. Now this is an example of Euro USD. This is in fact today's trade. Yes, today's trade. Yeah, today's trade. And if you look at this, normally with the market structure, you know this is a fake out happening here. But since we're talking about the entry method, now if you notice, as we spoke about before, the first bounce, second bounce, and this is the third bounce right here. The first bounce happening here, second bounce, and the third bounce, because this is a sell scenario. Don't forget, the first one is a buy scenario. This is a sell scenario. Now what do you need? As I explained in the first one, what you need is a channel. Secondly, it has to be the third or the fourth. Now with a volume candle, as you can see, this is a volume candle, and if you are taking your shots from there, you would have been risking about 12 pips for 19 pips. I'll take that any day. And as you can see here again, it happened that at the third one, it broke out of the channel. Mostly it usually do that. And if you master this entry very, very well, it will be game changing for you. All right, we'll move to the second one, which is looking for sweeps on high or lows of a consolidation. And this is a very good example. Remember I said consolidation is like this. Looks like a range, looks like a range like that. That's what consolidation is. So you're looking for sweeps on highs or lows of a consolidation, depending on their direction or the trend. All right, so for example, this is a downtrend. Now, as you can see, market is trending down to the downside here. Now this area is a place of a consolidation happening. Now you're looking for sweeps on the highs and lows, and as you can see, price went above this area and swept the people, swept the real move, stopped out people that are looking to short in this area probably. So definitely looking at this consolidation here, people are shorting here, also shorting here. Definitely some people want to short here. So this stops out people that are looking for move to that upside. You know, that's how this entry works. Yeah, and it also works like a fake out on a trend when the trend is happening. If you look at it very well, you know, this is a trend and this is a consolidation, breaks out, that's a fake out. But in this case, it is called a sweep of a high and a lows of a consolidation, but depending on the trend. Now this is a downtrend. Now as you see it now, it's a consolidation. It went up there, swept everyone looking for short, or probably anyone that is shorting in this area, swept them for this big move. And if you see something like this after the sweep, normally some of your other people, their entry will say from here they should put the stop loss somewhere here. But for me, the way I do it is immediately I see something like this, I wait for a retest, any retest. Now if you look at this place very well, after price did that sweep of the consolidation, broke down and came and retest this area here. Now this area is my proper entry. Now I will now take my shot from somewhere here. If you know me, I trade with a volume, a candlestick of volume. When I see that, I trade and I put my stop loss somewhere up there, and that is how I trade. The short for this entry method, for this sweep method. Now let's look for a long example, which means a buy example. Looking at this again, you see price was in downtrend, now in looking to go on an uptrend, as you see it here. Now price started consolidating in this area. Now look at the sweep that happened here. A swept. Definitely some people are looking, looking to go long here, and they will have set their stop loss below this area. Let me show you. Some people will have probably gone long in this area and put their stop loss just immediately below here, and they got stopped out. This is what they call a sweep of the low, and this one here that I just showed you guys here is a sweep of the eye. The sweep of the eyes on a downtrend. Look at that, the sweep of the eye, and this one is the sweep of the low, as you can see. Now the sweep of the low, this is another best entry method. Now for other people, they say after the sweep you go long, but me, I like to wait for a retest, just as you see it. If you look at this place very well, you'll see that a retest happens somewhere here. And when I see something here, I look for a volume candle. Where is my volume candle? I see a volume candle here, right here. And what do? I go long. Yeah, I put my stop loss somewhere here, and voila, that's 30 to 34 pips right there. So this is another best entry method you should use. Don't forget, you're looking for sweeps of the high and low of a consolidation depending on the trend of that market. You understand me? You want to look for a price to sweep the high and the low of a consolidation before the real move happen, after it has stopped out people here. All right, so the next one is the next entry method, which is trend lines. This is the third entry method, trend lines. Trend line is another entry method you really want to use. Now have it at the back of your mind that trend line is a good entry method, but to be combined with other factors. You can't use trend line alone. Okay, you can't use trend line alone. You need to combine with other methods and so on. But as the entry method we're talking about here, as I was talking about, what you need to do is look for a candle of volume. Now, before a trend on a trend line can be reckoned as a trend, it has to bounce off that trend line like 3 times. Like this is the first bounce, second bounce, and this is the third bounce. The third bounce here makes it a trend line, and you want your entry to be from this trend line at this third one, and with the volume candle right here. I'm sure you can see the volume candle right here. Yes, that's the volume candle, and that should be your entry right there. With that entry, with your stop loss below this, you could ride it, and that's about 238 pips there on the 4-hour time frame. Let's quickly go to the as you can see, this is the bearish example. This is the long example, trending to the upside, and this is trending to the downside. And as I said earlier, you cannot use trend line alone. You need to combine with other factors like market structure. If you look at this place, there's an area here, then you could use it with probably if you look at this place too, there's an area here, right here, you can combine, and there are factors here you can combine, and so on and so on and so on. But today we're only talking about the trend line as an entry method, but you need to combine it with other factors. That's just what I'm saying. And if you look at it here, look at the volume. I bounced here first time, second time, third one here makes it a trend line. All right, sloping to the downside. Now this is bounce. Now look for a volume candle around here and take your shot. This is a volume candle here, take your shot. All right, the fourth entry method, we are going to the fourth entry method, which is using the exponential moving averages to look for area of values. All right, and this is another good entry method. Okay, using the 200 EMA, which is the blue, the 50 EMA, which is the orange, and the 20 EMA, which is the red right here. And you are trying to look for price to pull back to the EMAs to give you reaction for a trend continuation, where we will have a trend move out of it. Okay, so you want to be looking for an area of value to the pull after the pullback of to the EMA. Is an area of value, is an area of value, this is an area of value after the pullback to the EMA, area of value. Where else? Okay, yeah, it's also an area of value, pullback to the EMA, and this is based on the bearish continuation when prices are moving to the downside. As you can see, it's sloping down nicely, and you need to understand that you don't want to be taking trades based on this touch of the EMAs only. There are other factors required to take these trades. Lots of factors required to take these trades, which we will not be going to right now. But these are the entry methods for another entry method using the exponential moving average. And if you want to really take this, you don't want to take it at the touch of the EMA. You want to add other factors like I've said earlier, and you probably want to go to the lower time frame to look for positions. So these are the area of values as I've noted. Let's quickly go to the GBPUSD. Looking at this after the breakout, this is an area of value right here. This is an area of value because it came back to the EMA. This is also an area of value. This is a bullish example of the entry methods. The bullish example, all you need to just look for the area of values on this, probably go to your lower time frame and look for an entry. So that is that. Okay, this is also an example of a bullish example. Area of value here, area of value here, area of value here. Basically, you want to take these trades not based on the touch alone, based on other factors. And if you want me to mentor you on other factors that you need, you can reach me on my Telegram, and I will be there for you. All right, we're going to the fifth entry method right now, which is regular divergence. This is the fifth entry method, regular divergence, which consists of the regular bearish divergence and the regular bullish divergence. Now, for the regular bearish divergence, you only want to be taking this regular bearish divergence on a bear market, a market that is going on the downside, trending downside. And regular bullish divergence, you only want to be taking this on a market that is going on the upside, trending to the upside. Now, if you look at this, this is a if I zoom, just allow me to zoom out, you'll see that starting from this point here, this is a bullish market. Therefore, I'm looking for regular bullish divergence. Now, in this case, it means the price is making a different thing, and the oscillator, which is your RSI, or some people use stochastic, is doing the same. Your price is doing the opposite, and your oscillator is also doing the opposite. I don't know if you get what I'm trying to say. The price is doing the opposite. Let me do an example. Price is making probably lower low, and your oscillator is making a higher high. Do you understand that? Let's get to it now. Now look at this example right here on this bullish market. Price started from this support here, came back down, and gave us missed a higher low here, and this area here on this regular I make a lower low on this regular bearish divergence. And look at the RSI here, is making a higher high. You don't see that clearly. Let me make it clear to you. And looking at it here, you see it's making a higher high right here. Let me click it. You see that it's making a higher high, which means this place is lower and this place is higher than the one. Look at this place. If you trace it to the downside, you see this is the area which is low, and this area that is on the lower low on the price here is on the higher high. Is on the lower high of the oscillator. That is how this regular divergence happen. And note this: you have to only use divergence on a trend. Regular bearish on a bear markets going to the down. Okay, this is another example of a bullish regular bullish divergence. Look at prices on the upside, and it came down here, and if you look at it did this nice lower low here, and if you look at the oscillator here, it's doing a higher low. You can see the higher low right there. This is the higher low right here, and if you trace to the downside, you see it's directly and the next one here is also directly on it, doing the higher low. So this is an example of the regular bullish divergence. And let's go to the regular bearish divergence. And okay, we are here. Remember I said you're only doing this on a trend. Make sure it's on a trend. As I zoom out, you can definitely see that this is on a downtrend market. All right, so let's quickly get to it right now. All right, as you can see, my first example here, you can see that price is on a higher high after price was coming down from this resistance cluster, coming down, and it made a higher high right here on the price. And on my oscillator down here, it was making a lower high, as you can see right there. This one is doing something different, this one is doing something different, That is how you know that's how you understand regular divergence on the trend. This is another good entry method when you are taking a trade, when you are taking your setup, when you can add all this, to your regular trading plan and see it turn out well. It's a game changer. And look at how price slopes down to the downside. Another example here on the downtrend market. Look at this. Price is also doing a higher high here, and look at the oscillator here. It's doing a lower high. Beautiful trade, and price went on a slope to the downside. All right, and our sixth and the last is that the last one? Yes, that's the last one. Our sixth entry method, we are going into it right now, which is the ATL channel. Now, before I go, I would like I would like you to like and please subscribe, share to your friends. They might want to this entry methods might be of help to some of them, and these entry methods they might benefit from one or two, as it will help to shaping their trading skills and their trading method. Once again, kindly like and subscribe so we can do more of this. Thank you. So as we are saying, this is ATL channel, and one rule of ATL channel is you only want to be using it on a trend. Make sure it is a trend. All right, do not use this on a ranging market. Now, looking at this example here on the Euro USD 1 hour time frame, this is a trend, downtrend to the downside. And looking at the downside, you only want to be using it on the positive one, ATR level. And where is my positive one ATR level? This is this is my positive one ATR level. This black line, as anytime the price gets to it and touches it. Looking at this one, it only touched it twice, and as you saw it, immediately it touched it, it bounced off to the downside. Let's look for another example. If there's sloping to the downside, looking at this one again, this is an ATL level, another ATL level here, another positive one ATL level, another ATL level. This is for short. Another one touching the ATL level, going on a downtrend that way. This is an example of an entry. This is even a discount entry method, using the ATL channel. And looking at the uptrend example, you only want to be using the negative one ATL level for the long on this ATL channel. And looking at this, this is my negative one ATL level here, another one here, of course. And of course, you only want to be using it on an uptrend market, as you can see, on an uptrend market, and touching my negative one area here, as you can see, sloping up to the downside, to the upside. Immediately it touches it, as you can see, bounces off, and this is an example, another example of an entry method using the ATL channel. Thank you and God bless. Like and subscribe, share.